Welcome to ProfitLed, the podcast for bootstrap entrepreneurs looking to make it happen. My name is Melissa Kwan. I'm the co-founder and CEO of eWebinar and your host. With me is my co-host for this season, Todd Parmley, eWebinar's COO. Hey, Todd, how's it going?
It's going well. It's a beautiful, foggy morning here in New York City.
Well, thanks for joining me today. I'm currently in Bangkok, like literally opposite ends of the earth.
Exactly.
Well, thanks for joining me today on the second podcast recording that we're doing together. In the last episode, we talked about how I chose eWebinar as the idea to pursue out of 1,000 other ones that, I had floating around. You talked about your experience as the first hire, not just at our startup, but also at a couple other ones prior to us, how you evaluated startups as, second in command, and some of the challenges that, you had given your previous gigs didn't really work out as planned. And so for those who missed the intro to our season 2 in the last episode, just a little recap for you. This season, Todd and I are going to relive our journey to $1 million, bootstrapping eWebinar from day one. Each episode, we're going to go in depth into one major aspect of our journey. We're going to share war stories, mistakes, lessons learned as we grew the company to $1 million in annual recurring revenue over a period of 36 months from product launch, which is actually at the time of this recording, not too long ago. Our hope is to give our listeners a window into the reality of what it's like to build a startup with very few resources. So today I thought we could talk about why we decided to bootstrap eWebinar versus raising venture capital, because I think this decision is what sets the foundation for all the other episodes that are going to follow, and also all of our decisions from who we hire, how we operate, to our culture, and why we are who we are. It's also something that I've been super vocal about, on social media, writing about that a few times a week on LinkedIn. And so if you haven't listened to the first episode of season 1, I'd like to invite you to go back and listen to it after this episode. It's where I share my own story and what compelled me to bootstrap my previous startup in the first place. And spoiler alert, I actually tried raising venture capital, but since nobody gave me money and we still had to survive, we became profitable quicker than getting a check from VCs. So Todd, where do you think we should start with today's topic? Maybe like why we decided to bootstrap eWebinar?
Well, I think maybe just start with sort of giving us your definition of bootstrapping, and then we'll go from there. How's that sound?
Yeah, sounds good. So bootstrapping, means building a company with no institutional capital, right? No venture capital, no growth equity. There are many other ways to fund a startup. So I think this is one of the biggest misconceptions about bootstrap startups is that they have zero capital. And the thing is, unless founders can avoid hiring anyone altogether, right, cover all the startup costs and sustain themselves until they get to some meaningful revenue, it's pretty likely that they're going to need some initial capital. And most founders invest their own money and maybe raise from friends and families to get started. And we did that as well. Right, David, my co-founder and my CTO, we were the ones that wrote the first checks. And we also had some initial funding from very close friends of ours. So bootstrapping really just means like you are not committing to venture style returns.
Right.
So I guess as most people know it, like a unicorn outcome.
Right. But besides putting in your own money, there were some other, what are the other funding options for startups? Besides putting in your own personal money?
Yeah, I mean, I think revenue from customers is like the most obvious and the best, right? Which, it's something that, I wanted to get to as quickly as possible myself. But if you're running a SaaS company, it's going to take some time to get there. And it's going to take time to build the product that someone's going to pay for. And I think Jason Lemkin was famous for saying this, and I quote this a lot. It's going to take 2 years to get to your first product. And why that's important is you need to make sure you can sustain yourself and, whatever team, whoever you're hiring for a minimum of 2 years. I want to add to that, which is you can get there in 2 years if you know exactly what you're doing. Like we got there, from idea to really like the first version of that product in, I think, something like 18 months, right? A little over a year and a
Yeah.
half.
Yep.
But I would add to say it takes another 2 years on top of that to get to some meaningful revenue, right? So
Right.
meaningful meaning like maybe 40K a month, 50K a month, where you can actually use that revenue maybe to get a loan from, companies like CapChase or whatnot. But outside of customer funding, of course, your salary, right? Your services, your consulting fees. Like the thing is nowadays, you don't have to be full time from day one, right? I
Right.
was
Right.
when I started my first company. I had saved up some money. I thought it was going to last a long time. It didn't. But nowadays, there are a lot of entrepreneurs, a lot of solopreneurs that are, that have side hustles
Yeah. Right.
to fund, their startup, right? There's of course friends and family. There are non-institutional funders as well. So family offices and angel investors, maybe entrepreneurs that have exited, that have
Yeah.
maybe
Right.
empathy for other
Right. Right.
entrepreneurs. If you're in places like Canada, where I was from, government grants. There's a lot of these government programs. I know that's why a lot of people move to Lisbon as well. I actually just read about a startup program in Chile. Like
Mm.
Chile's giving away something like 300 grand to start a business there. Of course, there are strings that are tied to that. Like you have to hire people there, and it's meant for that country's economy, but that does
Yeah.
exist. Business loans, especially if you have some sort of assets. And once you get to some sort of meaningful revenue, you can look at non-dilutive funding like CapChase or FounderPath that would take into consideration your MRR, your monthly
Yeah.
recurring revenue. I think the minimum is something like 15 to 20,000. So they'll
Can you
give
just
you a loan.
explain? Can you just explain non-dilutive funding a little bit? Like, what's the advantage to it?
Yeah. So you cannot get a loan from a bank unless you have something like $10 million, right, in
Right.
revenue. Like their banks are really like very, very risk averse, right? So you
Mm-hmm.
need significant asset and significant business before they actually give you a loan. That's just how they're set up. And now there are these, I want to say like kind of, they're not banks, but they're kind of like line of credit companies, like these credit
Yeah.
companies that
Yeah.
understand tech and they understand the business model of SaaS or consumer products.
Yeah.
And they will give you a loan based on your MRR if you have at least, depending on the company, like 1 or 2 years of operational history. So they'll
Mm.
take your MRR, look at how stable it is, look at your churn, like you basically just like connect your Stripe account, and they will give you a loan, say that is 3 to 5 times your monthly recurring revenue because
Mm.
they know they're going to get that back. And
Right.
usually
Right.
the payback period is pretty short, or the
Mm.
payback period is 1 year or maybe
Right.
maximum
Right.
2 years. And
Right.
the interest that you pay is actually baked into the monthly payment, but that's how they
Mm.
know that they're going to get repaid back.
Yeah. Right.
And tying your Stripe and your accounting software into their system is how they know that you're going to pay them back. But that is actually a new type of
Yeah.
funding that's really kind of just come up in the last 2 years.
Yeah. Yeah. That's what I thought.
So you're actually
Anything
not
else?
selling equity, right? Like that's the most
Right.
important, right? You're not actually selling equity. You're actually using the revenue that you have to get a loan against that.
Right. Hence non-dilutive. Right. So you're not diluting anything. Anything else you can think of for funding a bootstrap startup outside of
Yeah, I
your
mean,
own
I've
money
seen
in
some
together?
friends do crowdfunding. I'm
Right.
personally not,
Right.
I'm not,
Right.
I'm personally not very familiar with that. I don't know what that does to your cap table. Like, whether that means 100 people on your cap table or whether these 100 people that put in $1,000 are signing over power of attorney. But, there are platforms like AngelList or Republic or whatnot that do that. But I personally don't have experience with that. But I think
Right.
those work if you are, kind of an influencer founder, like a tech celebrity, or if you're doing something really cool and nifty, it's like kind of the Kickstarter model.
Right. Well, I mean, okay. So now that we've sort of talked a little bit about what bootstrapping is and how, the sort of misconceptions about how it gets funded from the beginning. I mean, you've sort of been, I think, dubbed the queen of bootstrapping on LinkedIn. At least that's what I've heard.
Yeah, that's what I'm going for. So it's working.
It's working, yes.
The persona I'm going for.
Yeah, good. So let's ask the question: why did you choose bootstrapping for eWebinar over virtual over VC? Because I know you've kind of been vocal about being anti-VC.
Yeah.
You become sort of an advocate for bootstrapping. So take us back to the beginning.
Yeah.
Why did you choose to bootstrap eWebinar?
Yeah, I mean, I think is like why I chose to bootstrap my last company. I mean, because that's where it really started.
Yeah, right.
I don't think I chose it, right? I think it chose me. And then I realized, oh, actually, this is a better way. So for those that, don't really know my story, and this is something that I told in the season 1, episode 1, more in depth, is I moved to New York to grow my previous startup that was in real estate tech. I had no idea what I was doing. So I saved up a bunch of money, got a loan against that, was pouring it into that company. I spent a lot of it very fast. And so for years in that business, I was actually struggling quite a bit. To the point where, I would take any side project, look for any government grant, any tax rebate to like cover payroll. Like I was just not in a good place. So when I moved to New York, I learned about, this thing called VCs because all my peers, because I was going to all these startup events and meetups and, trying to network, and all my peers were raising money. So I thought that a startup can only be successful if it raises money.
Yeah, right.
And it's only called a startup if it has money from VCs. But that's what it made me feel like, right? And this was quite a number of years ago. And so because I was struggling so hard, I was like, oh my God, I could actually build a company on someone else's money. That sounds amazing. Right? You mean I could actually go out and raise $1 million or whatever. At that point, it could be like $100,000. It would have made a huge difference. And I could value my company at like 5 million. That's awesome. So I actually just tried to raise money. I downloaded a deck, from the internet. I had pitch coaches. You go to all these like pitch competitions, and they teach you how to like craft your pitch. Like literally everybody was trying to teach you how to make a better pitch, so you could tell the story to get a check from VCs. Right. The problem was that idea never fully sit well with me. Like I was pitching VCs, but I was telling them a story I thought they wanted to hear. I wasn't really telling a story that I believed in. And I only really knew that after the fact because I was just so desperate. And the problem was like my previous business just wasn't a great business. It wasn't a venture scalable business. So it was actually like, it was not the VC's fault that I was not fundable. It was just not a great idea. But I didn't really have another choice. So I was pitching all these VCs. And then at the same time, I had to hustle to close deals and try to make this company grow and make payroll and all those things. So eventually, the first person paid us $10, and then within that year, we closed enough deals to be profitable, and I didn't have to raise money anymore. Yeah, and I was starting to call all my own shots. I was starting to be less stressed, and meanwhile, I saw all my other venture-backed friends get more stressed because now they took money and they are spending more than they're earning. And their revenue is not catching up faster than their cost. And so now they have to raise the next round and raise the next round and the next round. And so through that experience, I kind of saw two sides of the coin. So I saw that, when you take a check, it doesn't mean that it ends there. Right. When you take your first check, your second check, you're actually committing to a growth number to hire more people for, to hit a certain milestone. So, and if you can't fund yourself at that point, your entire life has to be pitching more VCs for the next round. So I didn't really know that when I went to pitch VCs. Nobody told me that. And that's why I saw my venture-backed friends become, more and more stressed out because actually some of them couldn't raise more rounds and they had to shut down. And I know that, through that process, instead of focusing on their customers, they were focusing on buying growth and not really doing what they authentically felt like was right for their business because they knew they needed to raise the next round. Meanwhile, my company of 6 was, we weren't getting market salaries at the time, but we were calling all of our own shots. I was digital nomading. I had already left New York. And I just kind of saw the difference between like having nobody on the board and being able to pay, being able to pay for everybody on your team and knowing that your revenue is covering your cost, and what a relief that was versus needing to rely on a third party for the survival of your business, right? It's not even like, I need this check to grow. It's like, I need this check to live. And therefore, I'm doing all these things. So it was the first time I saw how choosing your funding path ultimately determines your lifestyle. It has nothing to do with a company, right? And I think as I write about this, as I talk about this very vocally, a lot of founders will say, well, my VC is not like that, right? My VC really understands, all this stuff. But it's not like your VC is making you do all this. At no point am I like, okay, that VC is evil. It's just the model. It's just the business model. In order to hit that return, that is what's required. And therefore, that's what you have to do. Right. I don't think there's a VC that's like, Todd, you must go and do X, right? It just kind of comes with the game.
Yeah, right. Yeah, there's strings attached.
I think, and when I sold my previous company, I had, for the first time, I was able to think about the kind of company that I want to build.
Yeah.
Right. With the knowledge that I had acquired over a decade of building startups. And I knew at that moment that, like, if I were to do this again, I absolutely want to call all of my own shots. And if I ever were to raise capital, it would have to be on favorable terms, and I would not compromise my own life and my lifestyle for money.
Yeah. I think a lot of people think of bootstrapping in general as just harder, right? You sort of already talked about this a little bit, but what would you say to that? Because I think that's a widespread belief.
Yeah, and I think that is true to an extent, right? Like 100%, it is harder to get this going, right? Like, you remember, right, how difficult it was and how much, like all the corners we had to cut and, all the concessions that we had to make, right? And we still make those things.
Yeah.
Right. Less now that, we're over $1 million in ARR, but like under that, right? Like you have to make some serious concessions, and I do believe that it is much, much harder to get a business going.
Right.
Because in the beginning of a business, you also make a lot of wrong decisions. And those decisions are costly. Hiring the wrong person, dumping the wrong amount of money into a marketing campaign, right? Hiring the wrong marketing agency. But you wouldn't know those things until you do it. Right, making the wrong product decisions, and then because of that, you're 3 months behind where you thought you were going to be. Right. And money allows you to make those mistakes, but I do think that because there are no strings attached to someone else, when you are bootstrapping, once you get closer, like not even to profitability, right? The closer you get to profitability, the more stress is, I guess, relieved, right? The more pressure is relieved, right? It's the difference between, okay, every month we're burning 50K versus, oh, actually this month we're only burning 5K. And I could actually pull a loan from CapChase for 200 grand, like anytime I want. So now that pressure goes down as you see your burn, as your burn keeps going down, your stress also goes down. But while I think with a venture-backed company, you have a lot more cash to get the business going. But maybe when you hit $1 million ARR, you're actually burning 3 million.
Right.
And that's a huge spread. Right. So I think that it's just a different kind of stress. And I think I don't ever want to say one is better than the other.
Right.
But when I talk about bootstrapping, it's always about like my own lifestyle, because I don't want to speak for someone else. And I do know friends that like really want the IPO, right? They really believe that this idea is going to go somewhere. And that's what you have to believe, right? They really believe that if they get this cash injection, they're willing to push hard. They want to hire a lot of people. They love going to the office, right? They love all those things. And they love like shooting for the moon. And there
Yeah,
are
right.
people like that, but I'm not that person. But
Yeah,
I
right.
also think that there are a lot of founders that don't know that that's what comes, with the territory.
Yeah, I mean, what you said too about like making mistakes early on in a business. When you are constantly pursuing the next round of funding, you're not putting the attention that you should be on like the customer, the product, whatever, in order to like evaluate those mistakes. So even though you do make mistakes, right? There's no question we made mistakes, right? But your focus is 100% on growing the business and not split between growing the business and trying to raise money or appease your VC.
Yeah, and I mean, I think like now that I'm so deep into like, bootstrapping and
Yeah,
trying to grow this business as cost effectively as possible, like, and then
yeah,
now that I have such a larger community of founder friends, so I'm actually seeing both sides of the coin even more now that I've been in this for
yeah,
13 years.
yeah,
I
yeah,
do
yeah,
think that it changes the way you grow your business, right? Like we want to,
yeah.
because we're bootstrapped, we're not spending money on ads to buy revenue fast because we don't have that money.
Right.
We think about growing the business as how do we make the customer happy so that they will stay?
Exactly.
And that's a very different, maybe that's a slower way of growing, but I actually believe that's
Right.
a more sustainable way of growing.
Yeah.
Whereas if you have the money to spend and you know you need to raise money in 6 months, you need a certain growth number and you can just dump some money into hiring a CMO, figure out where to get, revenue, but hide the churn, right? Like,
Yeah. Yeah.
so it's a different way of growing your business. I would say that VC backed companies are revenue driven, but bootstrap companies like us are profit driven,
Yep.
which is actually how I came up with the name of this podcast.
Yeah. I
Is
was gonna
it's,
say
you know,
it's not a
yeah, bootstrap
coincidence.
founders, yeah, have to be profit led. And that is not to be
Exactly.
confused with, being revenue driven, which is like just help me make money anywhere.
Yeah, for the sake of it, right? For the sake of the growth. So, I mean, since one of the main kind of goals of this podcast is to give people a kind of on the ground look at what it's like to build a bootstrap startup, like in the most practical terms, we've talked about the general definition, but what does it mean for you to bootstrap a startup?
Yeah, I mean, I think in the simplest term, right?
Right,
Like
right.
like I said just now, it's really being profit driven,
Yeah,
and there are only two ways to increase profit, right?
yeah,
One is lower expense, like lower your burn, and the
yeah,
other one
right,
is to increase revenue.
right,
If you have both together, then you win. That's a winning formula, right? So I think what that meant for me from the very beginning was like, what kind of product do we have to release? Like,
yeah,
not eventually, but on day one, so
right.
that somebody will pay for it. I don't know if you remember back then, like I was so adamant that
Yep,
this product has to be revenue generating from day one. And having sold to the enterprise for like 10 years, I knew I had an idea of what companies are willing to pay for and what they're not.
yeah,
Right? If you
yeah,
deliver a business value, if you have certain features, they're willing to live without certain features. So I was pretty adamant about having a product that was very polished to the point where a company would put their credit card in. And because
yeah,
we don't have the luxury of not making money from day one, like that was my sole focus. And I
yeah.
remember like David not being fully on board with that, like our CTO not fully being on board with that because it was taking so
Hmm,
long to get out the door.
yeah,
But I knew what I was doing because I know how to sell a product because I'm also in sales. So I
yeah,
knew the pitch that I was going to give. And the second thing is about being profit driven is like ever since day one, like we were keeping our burn as low as possible. And that is not to be confused with being cheap. Being cheap means paying as little as possible. And I fully believe that, you know, um, if you pay peanuts, you get monkeys. So we are always looking to maximize the return on dollar. So there are people we
yeah,
pay a lot for, but because they're more productive, more efficient, and more experienced, and the quality of work is much higher.
Yeah,
right? So people like our
for sure.
writers, like our designer, we
For
pay a lot
sure.
for those people,
Yeah.
right? And I actually think that like that's probably one of the misconceptions too is like, oh, bootstrap companies are cheap, but they're not, right? Like at least not us. So the way we keep burn low is we hire the best quality for the dollars that we're able to spend,
Right.
right?
And
We
the
never
highest
spend the
return
most
on
because we can.
investment because of it. Right.
Yeah.
So we get the best possible outcome for the dollars that we spend. And just
Yeah,
going back to what
absolutely.
you were saying about like, when we were specking out the product, I remember we were doing feature sorting kind of exercises, and the litmus test was, can this make us money? Right. And if it was like,
Yeah.
no, this does not contribute to revenue in some way, we would just say, well, maybe we'll do it later. But yeah, we were very, very sort of vicious in how we prioritized the product in that way because we needed to get it out.
But I actually think because of that, bootstrap companies come up with a better product faster,
Absolutely.
right? Because
No
when you
question.
have money, you can be complacent. You can have a bunch of these features and be super cool. And you actually have the luxury of ignoring feedback
Yeah.
where
Right.
we don't. Like we still read every piece of feedback and whether it, is productive for us or not, like that's to be determined. But we care so much about the product even today that we read every single thing and ask ourselves, hey, is there merit to that? Right. So I actually think like one of the best things that you can do early on in a product is to be strapped for resource.
Yeah, yeah. I mean, necessity is the mother of invention, right? Like that is the story of my creative life. Every time that I've been in a situation where I sort of had unlimited resources and time, you get a crappier product because I mean, if you have limits, it always forces you to be creative.
When I first came to you, I know like
Yeah,
this,
yeah, yeah,
like wanting to build a bootstrap company and putting lifestyle ahead of revenue and happiness in front of business, like I
yeah,
was so adamant about that. Right. And I
yeah.
know that I explained to you like what I meant, which I guess is very different than most pitches that founders would give, people in
Right,
the beginning.
right.
Like I didn't really promise you like, millions in return at some point.
Yeah,
But I
right.
came to you and said, hey, Todd, this is the company I'm building. I want to build
Yeah.
a sustainable company that's going to last a long time. I want to build an ATM machine because starting a new company is really hard. Like,
Hmm.
what was your first reaction? Like, did you already have a concept of what that would mean for you?
I mean, the honest answer is no. I think in some ways, for better or for worse, if I believe in something, and I trust the person that I'm working with. I mean, this type of thing, understanding the nuances of funding companies, is not my strength. I mean, you know that. But I trusted that you understood it. I loved the idea of a lean, scrappy company that was going to figure it out, because every experience that I'd had in my professional career, even when I was inside a corporation, if we had autonomy and a limited resources, and we were really focused on meeting the needs of the customer, it was just the best. It was the best result. And so maybe I was a little naive, like, yeah, we'll make it work before we run out of money. We don't need that much money to make it work. You know what I mean? Like, but I guess also too, you kind of have to have that belief that you can just make it happen, that you'll figure it out
I mean, I think
as you
we
go
both
along.
underestimated how difficult it would be to have like a SaaS, like a product led growth SaaS company that's a low price point. Like, I
Yeah,
personally did not think it was going to be this hard.
no, we absolutely did. And I'm glad we did, right? Because we might not have been as sort of like, just let's make it happen. But then we figured it out as we went along, right? Which is ultimately all you can do. As obstacles come up, you figure it out. So, so how did you make it work with eWebinar? Like, um, so you make the decision, right? Or, I mean, I think you already know this. eWebinar is going to be bootstrapped. Then
Yeah.
what?
Yeah. I mean, I think a lot of people ask me that. Like, how did you make it work financially? Like, when people say,
Yes.
like, how did you make it work? Like, the first thing that comes to my mind is, like, how did you make it work financially?
And I think that's what
So I
most
had an
people are
exit.
asking. Yeah.
Yeah. Like, I mean, I had an exit before. So, like, in 2019. And I started this company 2 months after I exited.
Yeah.
And I think people, like, kind of, they brush that off very quickly. Like, oh, well, you had an exit. Of course you can do this. Right. Well, for 10 years, I didn't have an exit. So
Right.
don't forget that I also did what was required and took side projects and consulting and
Right.
put all of my money in and took loans wherever I could and got government grants. And I did all of those things. And in fact, like
Yeah.
I didn't pay off a lot of those loans until I sold my previous company. It's not something I fully recommend because it did put me in like very dark places. Like definitely avoid that if you can. But,
Mm.
you know, I just wasn't always in the luxurious position that I was in before and that I am in now.
Yeah.
So me personally, I did have an exit in 2019. David, who was my CTO co-founder, he had a consulting gig on the side. So he was already a fractional CTO for other companies. Like he had a startup
Yeah.
a few years ago, it didn't really work out. After that company, we're going to talk about this as well. But like after that company that he started or he founded with two other people didn't work out, he couldn't get back into something else because he didn't want someone else's schedule. So he
Yeah.
basically just became a fractional CTO for other companies. So he had this one gig that was like amazing. Like it basically was like 1 or 2 hours a week, and he got paid like I want to say like 8 or 9 grand a month or something like that.
Right.
And the thing is, he's fairly senior. So this is someone who spent 15 years at Microsoft, another 5 years in startups. So like, this is someone where people really value his opinion.
Yeah.
So that's something to take into consideration. But he had a gig that didn't consume a lot of his time, but paid him enough that we didn't have to pay him a lot more for
Yeah.
it to be like okay, for him to be okay.
Yeah.
And then we were working with you, right? Like you were the first person I came to
Yeah.
to help me on eWebinar, and you had a full time consulting gig.
Yeah.
And for a long
Which,
time, for a long time, you worked with us only on evenings and weekends.
yeah, and amazingly, that gig said when I asked them if I could go from 5 days a week to 4 days a week, they agreed, which I kind of couldn't believe, but it was amazing. It was an amazing setup. I was able to work 4 days a week for that company and make a good enough salary that the 1 day a week for eWebinar, didn't matter how much I was making.
Hey, I'd like to take a second here to talk about my own company, eWebinar, and our mission to rescue people from what I call webinar hell, to give them back their time and save them literally hundreds of hours every month through webinar automation. If your sales team is tired of doing the same demo over and over for unqualified leads or worse, prospects who don't even show up, an on-demand demo powered by eWebinar can help them get their time back so they can close more deals. If you're doing customer onboarding and training on repeat, eWebinar can help you automate those so you never have to do them live again. Customer success teams are using eWebinar to run hundreds of sessions every single month without a live host. Why don't you give our product a try and see for yourself? Visit ewebinar.com to join our own on-demand demo or to sign up for a free trial. All right, now that I've gotten that on my system, let's get back to the episode. Yeah, so myself, I didn't have to get paid. David, CTO, like I think we paid him an extra like $5,000 or something like that.
Yeah.
And this is someone in their 50s with two
Yeah.
kids, needs to pay child support. Like there are real expenses with
Yeah,
our
right.
team, right? It's not like we're
Yeah.
just a bunch of like coders eating ramen, right? Like we're way past that. And we had honest conversations about like what is the minimum that I need to survive.
Yeah.
And every day we would cross our fingers and be like, David, please don't lose that gig. And actually, he had that gig for like 2 years. Like I think
Yeah,
he only
for a
lost it
long time.
like a year ago, right? So, and
Yeah.
it wasn't because he wasn't doing well in that gig. It was because they shut down the department after like the pandemic. So
Right.
that was a bummer. But it actually delayed us that long, and then we of course had to make up for that. And then we were stretching like our runway with you for as long as possible until we couldn't anymore.
Yep.
And then we hired only contractors, and we still do, right? And I think the only reason our company can exist is because we can hire contractors anywhere
Yeah.
in the world based on skill set and passion and their mission alignment, and not locally, right? And
Yeah,
this
for
is something
sure.
that's very special with bootstrap companies, because when you take a check from VCs, they're going to know that they're going to want to know that their money is put to good use.
Yeah.
And a lot of times that means you have to be maybe in the Bay Area or New York or wherever they are, wherever talent is, you have to recruit locally, you have to be in the office, you have to do, things like offsite and all these fancy things that
Yep.
us as a bootstrap company can't do, right? And some people love that, right? Some people love to build a team locally, but I've always been remote. I was remote before it was cool, mostly because we couldn't afford an office. So I knew coming into this company that I only wanted to hire contractors. And so that
Yeah.
actually allows us to hire people in a country that they are at market rate or above.
Yeah.
And that's a beautiful thing, right? Like, so we work
Yes.
with a dev team in Vietnam, and then also started recently working with a dev team. It's a Norwegian company, but they have an office in Ukraine and they hire out of there. And we are very cautious about not overspending. So we hire the other people that we hire on an as needed basis would be, designers and writers for different types of content, but on an as needed basis. And I
Yeah.
actually think the model of hiring contractors is best for both sides because there's no reason why I need a writer full time, right?
Yeah. Right.
So if this is a writer that writes SEO long form content, I don't need that person full time. But I'm willing to pay the highest dollar for that person's time. And
Yep.
so are 5 other people. So that person is actually making more money with their
Yes,
full-time
right.
job because they're working with 6 to 10 people that value their expertise. And
Yeah.
that person can work remote anywhere. Right? So so I think that is how we kept costs low as low as possible. But also we did get a line of credit from CapChase when we were around like 45 to 50K MRR, which is because the markets were changing, economy wasn't doing very well last year. So when we could get a credit line, we did. Someone once told me that you need to get a loan when you don't need it. Because when you do need it, no one's going to give it to you. So that's kind of how we made it work, right? Like with the key people, we just stretched, we kind of just stretched our own capital. And then at the same time, we hired people anywhere in the world in places we could afford. And then eventually our customer revenue also caught up.
Yeah. Well, what were your biggest worries going through all this?
Yeah, I mean, definitely like running out of money. Right.
Yeah,
Like,
that.
so, I mean, we had, like, David and I wrote the first check, right?
Yeah.
We had also some friends and family funding, but there's still like a zero cash date. And I don't want to go out and raise any more money. Like, it's not a conversation that I want to have.
Yeah.
So, I have at any given time, I have 2 years projection, like always on Excel. Like, I know exactly how much we're making, how much runway we're going to have if we hire this person or invest here,
Yeah.
like when are we going to run out of money? So I always have that date in my head, and that's why getting the line of credit was a relief. Like, even though I didn't have to pull the whole thing right away, I knew I could have it if I needed.
Yeah.
And also, like, I mean, making those concessions, you're doing it on favors, right? Like, so one of the other worries is, okay, we have good momentum, but we're not paying people properly. And even though this is an amount, like, we always pay someone what they want or more. So I almost never negotiate. Like, I'll just walk away from that. Like, I'll always ask somebody, hey, like, if we engage you for this, what's it going to cost? If we can't afford it, we walk away. And then it's up to them to say, okay, maybe we can work out another arrangement. But I hate underpaying people. But along the way, because you're a small company and people have empathy for that, or maybe people believe in your project, they want to be a part of this project. So I know that for some people, we are making concessions, right? And so I think part of that worry is also like being afraid that because we're not paying people enough and that we do have momentum, that, they're going to leave, and then we're going to be, stuck, in a bad place.
Yeah. And in a small team, someone leaving is a big deal. So when did it get easier? Did it get easier?
Yeah. And I mean, like, I guess another worry is like, I guess not being able to hire the right people so that we can maximize our business. And I mean, we still kind of have some of that, right? Like we don't
Yeah.
have a person that is a CTO replacement or even
Right.
close to.
Right.
So are we not maximizing the business because we can't spend that money?
Yeah.
Right? Like if we had like 20 to 30K extra to hire a developer like David with 20 years experience, he would be able to hit the ground running. But we
Yeah.
don't have that.
Yeah.
Right?
Right.
So are we, or am I, not doing my co-founder and the team justice because we can't bring in these kind of resources, right? So these are
Yeah.
things that I think about, but at the same time, like these are the cards that you're dealt, right? So you
Yeah.
kind of have
Yeah,
to
for
like,
sure.
you just kind of have to work around it.
Yeah. So was there a point where things got easier? Where it felt like, I mean, I know you said that having the loan from CapChase sort of took a little pressure off, but was there anything else that where you felt like, okay, this is not such a grind?
Yeah, I mean, as the gap between revenue and
Yeah.
spend became smaller and smaller, right?
Yeah. Right.
And you don't have to grow like, first of all, I think hockey stick growth is a myth. That's a conversation for another day. But like, you don't have to grow exponentially month over month to have meaningful growth if your burn is reasonable, right? So we would grow, anywhere between 3,000 to, you know, uh, 7,000 a month, let's say.
Yeah.
So if you're growing like that every month for a year, that growth is quite meaningful, right?
Yeah.
Especially if you're not spending a lot per person. Like, 3 to 7,000 could be like a person, right? So, and because I do these projections, I know exactly what's coming in and what's going out. Like,
Right.
I think like sometime, like maybe 2 years into the business, or 2.5 years into the business, and mind you, we're really only 3 years into the business.
Yeah.
I saw that gap getting smaller and smaller. And that's when I think it got a bit easier. And that's when I was able to not work as many hours as I was, and, be able to quote unquote sleep better at night. I still don't sleep
Yeah.
super well at night. But like I mentioned, like if you're burning 60K a month, which at some point we were, that's a
Yeah.
lot of money.
Yeah.
Right.
It's a lot of money.
And then if you make another 10K, then you're only burning 50K. So actually that feels a bit better.
Yeah.
Right. And then
Right.
from 50K, and then if you're burning only 30K, then you're like, oh, actually, like I have this much cash in the bank. So I just divide that by 30K. Even if I don't grow at all, I can still last for a year. So like these are just some of the things that like I would be super conscious about. But it
And,
did get easier like as we got closer and closer to that point.
and when was break even?
It just depends like where you start counting, right? So like from the first day of like incorporation to the first person seeing the product, to product launch, right? Like 18 months.
Yeah.
And then, it was a little over 2 years before I felt like I was like in a fairly comfortable place. So let's say that was like 27 months. So
Mm-hmm.
it could be 27 months for some people that you ask, but it could be, at plus another 18 months. So I guess it would be like in total from day of incorporation,
Yeah.
maybe 45 months. And it's almost like 4 years, right? So
Yeah.
I had
That's not a.
mentioned, yeah, and I had mentioned in the beginning, like it's 2 years to get a product out and another
Yeah.
2 years to get to meaningful revenue if you know what you're doing, specifically at the price point that we're at, right? Like if you're selling $500 to $1,000 a month, right? It's a
Right.
very different world, but we started as a $50 product and now we're $100 product. But
Yeah.
I think a
Right.
lot of product led companies are also kind of at our price point.
Yeah. Agreed. So do you think VC funding would have moved the process along faster? Do you think it would have helped?
I'm actually not sure.
Yeah.
Because like I just don't know any different, right? Like
Yeah. Yeah.
I
Yeah.
know what I know is that money can't buy product market fit.
Yes.
And I still don't think we have product market fit.
Hmm.
right? And that's probably a conversation for another episode. But like, we have product market fit with one set of customer profile, but not for the customer profile that we want, right? So maybe, right? But I don't think you raise money so you can be more comfortable, right? You raise money so that you could scale a business. So I had mentioned, like, if I ever do raise money or take real capital, like, it has to be on my terms. How do you raise money on your terms, right? Like, you have to make sure that you have product market fit, and ideally have product channel fit, so that the money that's coming in is not to figure out your business. Taking money to figure out your business is the most expensive money that you can take, because you're going to need more. Whereas if you're just taking it to grow the business, to put it in these channels, you may or may not need more. And now you're doing it on your terms because you don't actually need it. Right.
Yeah.
So I
Yeah.
don't know if we would have moved faster. I think maybe, but like,
Yeah.
even
Who
if you were to
knows?
give me a check today, like, I would be scared to spend it
Hmm.
on like ads, for example,
Yeah.
because
Right.
I feel like I would just be throwing it out the
Yeah.
door.
Right. Yeah. It's like you want to throw fuel on the fire, but if there's no fire, it's just gonna there's nothing to burn. So yeah, I feel the same way. If we had a lot more money today, I think we'd still be very, very cautious about how we spent it to make sure that it was going to do something.
Yeah, and the thing is, like, you don't always have that luxury, right? Because if you
No.
take a check, you've promised a certain business
Right.
plan. Like, you
Right.
you
Right. Right.
raise money with a business plan. Like, these are
Yeah.
the things I'm going to do with this money, and this is the next milestone I'm going to get to. And then you have to execute that business plan, because if you don't, then you're not going to get the next check,
Yeah.
right? So I do think that, like, there is pressure to spend it right away in certain things if
Yep.
if you do take that check. And I guess the good news is, like, we've learned to do so much with so little. Like,
Yeah.
a lot of times people look at our product and they're like, what? Like, how many people are on your team?
Yeah.
Like,
Exactly.
how long have you been around?
Right. Well, let's switch gears a little bit. I know that at the beginning you said you mentioned that one of the biggest misconceptions people have about bootstrappers is that they don't raise there's zero capital involved. But what are some of the other misconceptions, the biggest ones people have about bootstrappers?
Yeah, this was actually my most viral post on LinkedIn in the summer, which I'll about, like, the 8 biggest misconceptions I hear about bootstrappers, which I'll share in the show notes of this episode as well. But other ones include, we don't want to give any equity away, right? And the thing is, it's not about not, like, hogging our equity and, like, wanting to keep 100%. It's just, we don't want to give away our freedom, right?
Right.
I remember in New York, in my previous startup, when I was suffering so much, and I couldn't just raise money. A friend of mine, we were at, like, we were having drinks, and I was, like, kind of complaining to him, and he was like, "Why don't you just go and raise some money? Like, don't like you don't have to keep all the equity." And, like, that's what he thought.
Yeah.
But number one, like, nobody would give me a check. I was trying. Like, I really was trying.
Right.
But later on, I realized, oh, actually, it's not like the freedom is actually tied to the equity. So with a bit
Yes.
of equity that you're selling, a bit of freedom goes along with it, right? And the freedom is, like, in your board seat, right? Like, you
Yeah.
can't change the direction of the company. You can't make massive, a massive hire, or, like, you can't spend a lot on an executive hire without getting that approval, right? Like, it's there to make sure that you are operating the business well, and that's the freedom that you're giving away. Another one is, like, we're less ambitious, and I, like, blame the media for that, because the media thinks, oh, like, if you have VC money, you're a real startup and you want to be a unicorn. But also, like, a lot of times, like, in the past, when I went to raise money from VCs, the first, when they hear, like, oh, this business is not venture scalable, I guess it's okay if you want to build a lifestyle business. Like, they
Right.
immediately diminish your value and the value of your startup by making it seem like you're less ambitious if you're working on an idea that's not venture scalable, right?
Right.
And that is a complete myth. And, like, I have a theory about that. Like, I think like lifestyle businesses are not good for their business.
Yeah.
So
Right.
like their business is based on unicorn companies.
Yeah.
So I think it's kind of natural for them to kind of diminish your value in your business if you
Right.
don't want to do, what they want to do. And the other thing is like we're unable to raise venture capital. That's not always the case, right? Sometimes that's the case, right? In my previous
Yeah.
startup, that was the case. But right now, if we wanted to raise venture capital, we can,
Yeah.
but we just don't want to, right? And that all goes back to like the lifestyle that we want to lead. Another one is like we're cheap. Oh, you're bootstrapped. You don't want to pay. You're cheap. But like I mentioned before, like we're not cheap. We're just cost conscious because we
Right.
don't have the luxury to like pay a lot for somebody and to test people. So we have to maximize our ROI per dollar. Another one is like we don't make money for a while.
Hmm.
I think maybe sometimes that's true if you can sustain yourself, but like we do make money because we have to survive. We're also real people. But we don't always make money right away from the startup that we're bootstrapping,
Hmm.
right? Like you had a side gig, David had a side hustle, right? Like,
Yeah.
there are like I know other people on our team have side hustles as well. And sometimes you need that also to get creative or to stay creative. So I don't discourage
Yeah.
that. But we do make money and we find ways to make money to fund the thing that we want to do, right? That we think eventually will give us the most return. And another one is that, we have smaller exits, and that
Right.
is completely untrue, right? We own more of the company, right?
Hmm.
So
Right.
we need a smaller exit to have a bigger personal exit. So if you own 10% of the company, say you have a co-founder, so that both of you own 20% of the company, but you sell for 100 million, which it's very hard to sell a company for 100 million. You're getting 10 million each, right?
Yeah.
But if my co-founder and I own 100% of the company, I can sell the company for 20 million and we have 10 million each, right? So we need a much smaller exit for the same or more outcome.
Yeah.
And I think the last misconception is that we struggle more, which is what you asked before. Is like, is it really harder? Yeah, I think we struggle more, absolutely, in the beginning.
Yeah.
But for the majority of our business, if we actually make it,
Hmm.
I think we're actually more chill.
So you talk about this idea of a lifestyle company. I know that was sort of at the core of why, you know, around the decision to bootstrap eWebinar. So how has the decision to bootstrap eWebinar sort of shaped the culture of eWebinar? And I'd love to hear what you have to say about what even a lifestyle company is, because I do think it's a term that people kind of like poo poo, you know?
Well, I mean, if anything between like zero and unicorn is a lifestyle company, then I'll take that.
Yeah, right.
And also, like a really important thing to mention is only 1% of startups are venture backed. So
Yeah, right.
99% are not venture backed. So we're actually the norm. It's just we read more about the 1%. So
Right.
we think that we think we're unique, but we're actually not, right? Like, so maybe 99% of businesses are actually quote unquote lifestyle businesses, right? So
Right.
when I think about like how that has shaped like the culture at eWebinar, it's really
Yeah.
three things that stand out. Is like, number one is our team. Number
Hmm.
two is our work culture.
Hmm.
And number three is how we make decisions on everything. Some of the things that we've actually touched on. Right.
Yeah.
So for me, building a lifestyle company means prioritizing your life over work and happiness over revenue.
Yeah.
And that is who we are so much that is the first conversation I have in every interview. Right. So with every new hire, like I'll go through, the standard, get to know you questions.
Right.
But if I think, okay, this is the person I want to bring on board, I give them this whole spiel. Right. Because I know that number one, we can't afford to pay top dollar.
Yep.
And number two, we can only really retain people who value, who value this kind of lifestyle over work so much that they're willing to not hop to a company for more money. if that makes
Right.
sense, right?
Yeah,
So
it
I need
absolutely
them to
does.
know that by working with us, that we're going to care about you and your lifestyle more than anything else. All right. And that means like you can work remote, you can take a Friday off. You don't have to tell me, just let someone know that you're going to be gone. Like, don't just disappear.
Yeah.
We don't have a holiday policy, all those things, right? So
Yep.
as a small company, it's the only thing that we can use to compete against everyone else
Right.
who's competing on salary. In the past, in my last company, it was also had a very similar culture. We were in Vancouver as well at the time, and we were paying people. We just couldn't afford people, right? So we were paying people. I want to say like 50% of market salary. So if I'm taking like an Amazon or Facebook as a market salary in a big company, we were paying 50% of that. And
Right.
even then, people were not leaving
Hmm.
because they didn't want to lose the freedom.
Yeah.
And that's how much some people value that. The people
Right.
who value like the amount of salary that they get, they can never work for a startup, right? The
Yeah.
people that like will hop to the next highest salary opportunity or the biggest benefit, like they're just not going to last. And what we have to offer them is not compelling anyway.
Yeah.
So I
Right.
think like just having that as top of mind, that really determines even the type of person that we attract,
Yeah,
right? So
for
I think
sure.
that's number one. Um, and so we want to build like a small and effective team who love our mission and our culture and want to be part of the team because of that, right?
Mm-hmm.
And I think that brings the culture that brings is like, because we're remote, because we're so small, um, and because of all the things that I just talked about, like because people value being here so much, I think naturally the work culture is um, there's a strong sense of accountability,
Yeah.
right? Like we don't have time or luxury to micromanage. So everybody that this type of culture attracts are like self learners, they're self motivated, and they want to contribute, and they're always curious, and they're learning things on their own. Like we almost never talk to them. And
Yeah.
not everyone fits into that, right? Like everyone thinks they're that person, but most people are not that person, especially if you're more junior.
Yeah.
Like I would
Right.
say like most people that are senior already kind of know this, right? But
Yeah.
I would say it's very, very hard for juniors to be like self-motivated, not being in an office, learning on your own. Takes a very special character. And if you're not that person, you actually weed yourself out pretty quickly. And we're getting better at identifying that. But I would say like first
Yeah.
1 or 2 months, we already know. So I think it like because of that person that we attract, it creates a work culture where it's like everyone just takes ownership of what they
Yeah. That's
do and they understand that customer is most important. Like nobody's going
yeah.
to be like, Melissa, why did you message me on Saturday?
Right.
Right? Because
Right.
the thing is, yeah, because they know that I want them to take days off. So if
Right.
I message them on Saturday, it's an important thing. Or
Yeah.
if
Right.
David says, hey, something is down, no one's going to be like, well, it's my Sunday. They know
Right.
that if they get that text, it's something that's super important
Right.
that they can hop on, right? And I think there's beauty in that, right? Because now we're bringing on people who love what we're doing, who are highly effective individuals on their own and highly productive, so we could actually have a smaller team because we trust everybody to do what they do so much that we don't need more people to fill the gaps, right? And I think the third is, you know, how we make decisions, right? So because we can't waste time on resources and things that don't drive revenue, um like we basically have to be, as I mentioned, like super cost conscious, which is not the same as being cheap. um but we make decisions really based on like, does this make money or not, or does this lower cost or not? And that
Yeah.
goes from how long we keep someone that we know isn't working out on the team, to the product decisions that we make, to the people that we bring, right?
Yeah.
So yeah, I think that those are the major three things: is like team, work culture, and like how we make decisions on like literally everything.
Yeah. I mean, ownership is the word that came to my mind immediately when you started talking. It's like it's the thing that that to me is the sort of the same. It's completely attached to the idea of the freedom that you have. It's like, because you have the freedom, I know I just have to get my work done. I take pride in my work. I love the fact that I don't have to go through 27 like rounds of red tape to get something done, which is like another reason why I wanted to be at a small team. But like, if I feel like I'm trusted to get the work done, I have the freedom to sort of make my own schedule. I actually take so much more ownership in the process that that the work is just, it's just, first of all, it's so much more enjoyable, right? I mean, we don't have to talk to each other, right? We are very autonomous, but we like to talk to each other. That's another reason why I wanted to be at a small team with people that I really liked, because, you know, I want to be autonomous, but at the same time, having people that I really like, that I trust also, that I can kind of bounce ideas off of. But then know, once the decision has been made, I can just run with it. Like, those are all the things that kind of drew me to this team. Was that
Yeah, but
kind
you
of
didn't know that,
freedom?
right, at the beginning. Like
No.
when I just came to you with this, like you didn't really know that that was the case, right? But like, are there certain things you were surprised by, or how do some of these things translate for you, not just in your professional life, but like in your everyday life?
Well, I mean, in the most practical terms, like, I can say I'm taking this day off. Like, like, I'll let you know. Like, it's not, I'm not having to ask. If I want to
Yeah.
take the whole middle of the day off to go do something, I can go do it, and then I'll either work later, or I'll work a couple of hours on the weekend. But it's like, the relationship between work and life become work and like everyday life becomes so much more fluid, that I just relax more. Because I trust that I'll get things done. I mean, there's always stuff to be done. That, in some ways, like, also being bootstrapped, you do have to make decisions about where you're going to put your effort, knowing that there's something you're not going to do, right? And that would have stressed me out for some reason at a larger corporation, but here it's just the reality. And so I'm like, this is what we're working on now. This is what we can work on now, based on the time and resources we have. And if something changes, we'll adjust, right? We just keep adjusting as we learn. So
Yeah, I mean,
um
I think like before, like everybody used to say, okay, well, how do you manage work life balance? And I
yeah,
always have like some perfect answer for that. But now, like, because before, like, I didn't love my job, right? And
yeah,
so
yeah,
I think it was tough because I had mentioned in my previous business it wasn't a great business. And because it wasn't a great business, I didn't always love my job. And
yeah,
that's a much larger conversation. But in this business, I actively chose this company. I chose this type of company, this particular idea, and I built this company on the premise that I was going to put life ahead of revenue,
yeah,
like fun in front of business. And everybody is, on board with that. All
yeah,
right. And so it's allowed me, and I didn't know this was going to happen, but it happened, which now my life and my work is integrated.
yeah,
Like
right.
it's so integrated. And the thing is, like, if you think about it as a founder, right, or even on the founding team, that like where you really love this product and you want to see it grow, like,
Yeah,
why does it have to be two separate things, right? Like you
yeah,
can't compartmentalize yourself. I'm thinking about it. I dream this thing all the time. I
yeah,
wake up thinking about this thing. So why does there have to be work life balance, right?
right.
Um, yeah. So I think now, like, because I put lifestyle ahead of everything else, like I'm able to build a life where life and work is kind of the same thing, and it
Yeah,
doesn't really stress me out, or it doesn't make me feel like it doesn't make me feel guilty if I'm doing something on the weekend or doing something on vacation. Like I don't feel like I have to like cut this off.
yeah,
And in fact, I think it's like by integrating the two, it's allowed me to have a much more balanced life.
yeah, for sure. I mean, that's what I mean by it feeling more fluid. Like, if I find myself thinking about, something related to eWebinar while I'm quote unquote off, it doesn't feel odd, because it's just part of the same. I like the fact that I can kind of ruminate on ideas and take some time off and walk around or go run some errands and then come back. Okay, that I'm not tied to a desk, 9 to 5, 5 days a week. It makes a huge difference for me. And one thing I just wanted to say is earlier you said, but Todd, you didn't know. And one thing I will say is that occasionally in my life, I have like a really powerful gut instinct. And I was like, oh, I think this is it. But I was willing to be wrong, and I told my partner, I told Jeff that I was like, you know, in a year, if I'm wrong, I'm wrong. Right. But, I at least went into it with the idea that I really felt strongly that this was going to be a great opportunity for me. And thankfully, it turned out to be true.
But were you worried that you weren't going to get paid properly? And for people that don't remember, like Todd lives in New York. So
Yeah. Right.
that is not a cheap place to live in. It's probably one of the most expensive. So like, and at the time you were also full-time, consulting with another company that was paying you pretty
Yeah.
well. So
Yeah.
like, how did you think about that? Or did you think about that at all?
Well, uh, in a pretty naive way, I wish I've told you this before. I wish I was more money motivated because I sort of just dive into things that I believe in. I mean, I directed theater for years. I have no idea how I lived off of that income looking back.
You were
But
much younger.
yes, that did help. But yeah, sure, I was worried. Sure, I was worried. I'm in my 50s. For the first time, like I'm like, oh wait, I will retire someday. What am I going to do about that? So I was worried, but I had also heard you talk about how you never missed payroll at your previous company, even when you were um, strapped and you weren't paying yourself, and which I didn't love that part, honestly, but like I knew that you had integrity, and honestly, I had worked with um, CEOs at other startups who did not have integrity, who went back on their word about what they would pay me. So I you know, was assuming you weren't outright lying to me, first of all, but that you had had integrity in the past to pay people what you said you were going to pay them. And so that did actually alleviate a lot of my fears. But look, if the idea wasn't working, if the opportunity wasn't working in a year, I would have had to move on. And then when I
Yeah.
got to a year, I was like, I'll wait 2 years. And then, but at that, even at a year, I had no reason to believe that this wasn't going to kind of go somewhere.
Yeah, and the thing is, like, we did have an honest conversation about, when I asked you to come over full time, like we
Yeah.
did have an honest conversation about like, okay, so what is the amount you need
Yeah.
minimum to live, right? And that's the
Yeah.
relationship that you need with your founding team,
Right.
right? Like it's not like I'm going to keep my number from you, and so I could try to get more from you. Like you can't have those
No,
relationships,
no,
right? Like
no, no,
especially in a
absolutely not.
bootstrap company, like it's not like I don't believe, your teammates or your family. Like that's not the case, but like you have to be so honest with them about where you are because you're bootstrapped.
Yeah.
Like you can
For,
look at my financial statements, you can look at the bank accounts. In fact, like, the founding team has access to the projections and the bank accounts. Like at any given time, everyone knows how much money is in the bank account so they can make the best decisions for the company. And even if that means in the beginning, we all make some concessions and say, okay, this is just the minimum that I need. So
yeah.
can we make this
And
work?
yeah. And I mean, that minimum was, so I went and looked at my expenses, right? What do I need? But then I also looked at what I had in savings as well. Right. And so even the number that we initially started with was me drawing on some savings, but at a very low rate over time. I mean, it's the reality of living in New York is that it's just not cheap. It's not, it's not cheap. So, um,
Well, you're not really a New Yorker unless you're spending your savings.
yeah, that's true. That's correct.
Unless you're in the red. Are
Yeah,
you really
exactly.
from New York?
50% of your income is going to housing or whatever.
Oh, yeah, minimum.
We're getting kind of close to wrapping up, but before we do, I want to ask you, like, what sage advice would you want other bootstrappers listening to now to know? Like, if you considering everything we talked about today, what would you want to kind of share as the advice?
Yeah, I mean, I think make no mistake, it's extremely, extremely hard.
Yeah.
But it's possible. And it does get easier with experience, right? Because if you, like, I don't believe success is like repeatable, right? Just because you had one doesn't mean you're going to have another, but you do get better at making decisions and saying yes and no to the right things so that you can get to revenue faster.
Yeah.
Um, and I want to reiterate that only 1% of startups are venture funded, right? That means 99% of startups are just like us
Yeah.
that are bootstrapped and making it work. And you don't have to start really big, right? The idea that like you have to quit your job and build this thing and it's going to make a splash, like you don't need those things, right? You can and you probably should start small, especially if it's your first one and you have no idea what you're doing, right? Like go to
Yeah.
acquire.com, see what other people are doing, right? Subscribe to the platform, try to acquire a startup maybe, right? For 10K, 20K, whatever that might be, that can cut down your time to, research and development and testing things. But you will need capital, right? And it's not just for like investing in your business and paying yourself if you're not, if you don't have any consulting fees or salary on the side, but it's also for like hiring people. So don't forget your personal runway. Like take care of yourself because it is so hard. It's probably the best thing that you can do for your business. And I know this because I didn't take care of myself for
Yeah.
my first two startups. I didn't know better, right? I was
Mhm.
too naive to think that business is easy. My family's not like I didn't come from a family of entrepreneurs. So everything I had to learn from scratch, right? So
Mhm.
um, everything that I did took like 5 times longer instead of like 2 times longer. So I was always too optimistic about what the business would look like and getting to revenue and how long it would take to get someone to pay you, right? So don't underestimate any of those things like I did, right?
Yeah.
Like make sure you have a personal runway, do a projection, don't quit your job or quit your job, but have a side hustle, or have a side hustle while you're at your job. And then when you feel comfortable, right, then you can quit your job. Like there's so many different ways that you can kind of piece it together, but you do not have to start big. I spent years in debt, living on a dime, living off the kindness of other people. It was not fun. Like honestly, it scarred me for life. I still live with some of that PTSD. Um, but
Yeah.
if you make it, and when you make it, all of that suffering is going to be worth it,
Right.
right? Because
Yeah, for sure.
once you hit profitability, that means that you are building a business forever. Like in theory, you
Yeah.
have a forever business, right? Assuming that you're going to keep growing and improving your business and not letting it slide, like you have a forever business and you will never have a boss again. And that, like, as a founder, like I don't know of another feeling that is better than that.
Well, I think that's a good place to end. That's a nice upbeat note. So let me just wrap up with a summary of what we talked about today. So we talked about why you chose to bootstrap eWebinar, what it means to run for you to run a bootstrap company, misconceptions people have about bootstrapping, and how bootstrapping has shaped eWebinar. So we were going to end each of these episodes with a hot take. So I think maybe you might have already given your hot take. I'm not sure, but what is your hot take? Keeping all that in
Yeah,
mind,
so
what
many
is
hot
your hot
takes.
take? I know. Well,
If I had to pick
that's good.
one hot take,
Yeah.
yeah, I think a lot of people think about bootstrapping as a financial decision, right? Because it's like, it's a way of funding your business. But it's really a lifestyle choice, and I don't just mean that for myself. Like I know just from like knowing other bootstrap founders that it is like bootstrapping a business or raising VC is really a lifestyle choice, right? The kind of life that you want to live is fully dictated by the capital you choose to fund your business with, right? And we talked about that, early in this podcast. Most founders don't understand this yet, but there are so many resources now, like so many podcasts, so many blogs that are, so many people on LinkedIn that are also writing about the exact same thing, right? Like my friend Greg Head, for example, he's got the Practical Founders podcast, which is a great bootstrappers podcast, by the way. And he said this one thing that really stuck with me, right? The first rule of the game is to know what game you're playing. So yeah, bootstrap, raise VC, get friends and family funding, whatever it is,
Right.
just know what game you're playing. And in that way, I think, bootstrapping is really a lifestyle choice. So Todd, what is your hot take? I know we covered a lot today.
I think mine is simple. Mine is learn to trust your gut, knowing that if things don't work out, you can trust yourself to navigate whatever comes up. It's like the phrase trust but verify. It's like, if you have this impulse, this desire to do something, go for it, knowing that if it doesn't work, you can make a different choice. So that's my hot take. Trust your gut.
I think that's a good one. I think that's a good place to wrap up. So if there are particular topics that you want us to get into this season, please let me know by connecting with me on LinkedIn. If you have any feedback about this podcast, I'd love to hear from you. My name is Melissa Kwan, last name spelled Kwan. And if what we've talked about today resonates with you, subscribe to ProfitLed on your favorite podcast app to get notified of new episodes, and join our mailing list by going to profitled.fm. I promise to only share things you'll actually care about. Thank you so much for listening to this episode.